This is Trade Flow News, bringing you relevant news and insights from around the world. Trade Flow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
The engine of the U.S. offshore energy production struggled to recover from Hurricane Ida on Friday as a lack of crews, power and fuel left most Gulf Coast oil and gas output offline 5 days after the storm passed. Ports were reopening, crews returning to offshore facilities and some pipelines restarted as companies completed post-storm evaluations. But getting oil flowing again was more difficult as damage at hubs slowed larger facilities. A lack of power onshore kept some refiners sidelined. About half the originally evacuated platforms remained unoccupied and 93% of oil production and 89% of natural gas was offline, government data showed. Some wells in the Gulf of Mexico, which accounts for about a fifth of U.S. output, could be shut for weeks, analysts said.
China will launch more futures contracts, including a shipping futures contract, and accelerate efforts to bring in more overseas investors to trade in its futures market, the State Council, or Cabinet, said on Friday. China will also establish an international, yuan-denominated commodity futures market, it said in a statement on promoting trade and investment in its free trade zones. The Cabinet announcement comes amid China's increasing efforts to become a global commodities pricing power, with the country gradually opening up more commodities derivative contracts to overseas participants for trading.
Moving on to the top news in the energy sector.
Surging liquefied natural gas, LNG, prices are prompting utilities across Asia and the Middle East to burn more high-sulfur fuel oil, HSFO, than usual to meet increased power demand during summer, analysts and traders said. The move towards the cheaper but more polluting HSFO highlights the problems faced by developing countries which have to grapple with the economics of lower costs versus meeting emission-cutting standards. The strong demand for the residual fuel oil could last beyond the summer as the global economic recovery from the coronavirus gathers momentum and global LNG prices hold firm at more than twice where they averaged in 2020, the analyst said.
Asia's gasoil market is showing signs of life, despite lackluster regional demand in the wake of widespread coronavirus outbreaks, as Europe sucks up cargoes to restock heating oil in the peak demand period ahead of winter. Steady arbitrage flows to Europe have boosted cash differentials for the benchmark 10 ppm gasoil grade in Singapore to their biggest premium since July last year on Thursday, while gasoil refining profit margins are at their strongest since April 2020. The East-West gasoil arb will likely remain open in the near term, as firming demand in Europe leading up to winter heating contrasts against weakness in Asia, said Serena Huang, a senior market analyst at oil analytics firm Vortexa. Next, we have the top news in metal markets. A prolonged period of high aluminium prices created partly by output cuts in China is expected to encourage new capacity in other parts of the world, which will eventually weigh on prices trading at 10-year highs. Benchmark aluminium on the London Metal Exchange hit $2,734.50 a ton on Wednesday, a gain of 37% this year and the highest since May 2011. Aluminium is widely used in the transport, packaging and construction industries. Robust demand growth, surging freight costs and shortages in Europe and the United States started the rally earlier this year, with China picking up the baton in recent months by imposing output cuts to reduce power use and cut emissions.
Copper prices climbed on Friday as the dollar was dragged down by a lackluster reading of the U.S. jobs market, stoking optimism for a more gradual tapering of stimulus in the world's largest economy. Benchmark copper on the London Metal Exchange was up 0.6% at $9,439 per ton by 1600 GMT. The metal used mainly in power and construction is set to end the week marginally higher, adding to a 4% weekly gain in the previous week.
We will now look at the top news in the agricultural sector.
Chinese importers have cancelled a series of animal feed barley shipments from the Black Sea region in recent weeks due to weaker than expected domestic demand and expectations for a large corn crop, traders in Asia and Europe said on Friday. Some traders said at least 5 shipments of barley from Ukraine were cancelled. Others put the volume at around 7 shipments, totaling some 400,000 tons. The shipments were due to load in the fourth quarter of this year. Low profit margins for hog farmers have reduced demand for feed grains in China, while congestion at major Chinese ports continued to delay import shipments, traders said. That is all for today's news on commodity markets. Stay tuned to Trade Flow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at Trade Flow News, which allows you to watch our program on your mobile device or desktop to receive information from there.